Bonds remain a mystery to many investors, and yet they are a common investment. In a few minutes, we'll explain what a bond is. Wednesday Wisdom Nuggets brought to you by Open a stock trading account today with a trading platform that makes share trading easy. Our experts even tell you what and when to buy or sell. So, what is a bond, and why are so many investors obsessed with this investment option? Let's begin with an example. Suppose the government needs to build a highway. In order to build the road, they need money. They may decide to build this road through taxes or may opt for public debt. In this latter instance, the government would raise money by taking loans from the public. How? Through bonds. First, the government publicly advertises an infrastructure bond. Second, the investor buys the bond from the government, and each year, the government pays the investor interest. At the end of the period, when the bond expires, the government pays back the initial borrowed amount. As you've likely noted, bonds operate a lot like loans. The government, as the borrower, pays interest during the period and then pays back the initial borrowed amount at maturity. This is a good deal for both the investor and the government. The government received the money they needed to build the highway, and the investors received regular interest payments and the return of the original investment at the end of the period. Before you get excited about your newfound ability to have government indebted to you, let's go over other means that you can make money through holding a bond. A second source of return for a bond is that investors can sell their bond to other investors. If you want to get out of the debt agreement for whatever reason, you can sell your bond to another investor. The investor pays for the bond and receives your future interest payments in your place. Important to note is that the market value of the bond changes over time. In other words, what you bought the bond for and what you can sell it for will be different. This is because the bond value has a negative relationship with the interest rate. If the interest rate decreases during the period you hold the bond, the market value of your bond will increase and vice versa. Sounds confusing? Look at it this way. Suppose, for reasons we won't go into in this video, the interest rate decreases. Because the interest payments on your bond are fixed, they will be higher than the interest rate in the market. Bonds of the same value as yours will have a lower interest rate attached to them. Given that your bond is more attractive than other bonds, if another investor wants to buy your bond from you, they will have to buy it at a premium price. There's more to say about this investment option, so subscribe to this channel to make sure you don't miss a video. Download the AIB DigiTrader app today and become an investor. We'll help you along the way.